Hey everybody, today I have for you an interview that I did with one Andreas Klenau. And don't worry about how you say his name, apparently everybody says it wrong, but Andreas is the author of several books, including Following the Trend, which is about momentum strategies and funds and kind of more the professional side of the industry. So I had been following him on LinkedIn, saw him complaining about people impersonating him, and so we had a little bit of conversation and back and forth about that. That's how I got him to notice me. And so I suggested that we do an interview so that you guys could kind of get some insight into more of the professional side of the industry. And this is hopefully going to be the first of many interviews that I plan on doing through the year. But because it's the first, we did have a couple of kinks to work out. So I actually lost the first little bit of the recording. So it will seem like we kind of start in the middle of a conversation, but don't worry, you didn't really miss too much. I also had to make a few cuts because our connection dropped out a few times, but I'm not sure you guys will even notice where the cuts are. But watching it over again, I really enjoyed this interview, and I think you guys will too. So enjoy.
I did finance for a while in 1999. Now, how lucky is that? I wasn't part of the whole crash. It's pure dumb luck, right? I mean, it's not like I thought we're at the top here, I'm going to stop doing this stuff. It's, I got a job. So I spent some years, first I think I spent about 2 years being some sort of Nordic manager for a group of financial consultants. Then I got transferred to Geneva. They always have funny job titles and those things. I think I was global head of equities and commodities analytics, something like that. So I had a group of financial engineers working for me back in Geneva, building stuff. And that's when I realized it's time to get out of here and do something different, because corporate world was not agreeing with me, or I didn't like it very much. So that means as well, when I run into these people, when it was time to do something different and get out and go back into finance, timing was pretty good. I mean, we were past the bear market. I spent the bear market in corporate world, and here we go, bull market. I'm back out again.
Right.
So, yeah, that's
interesting. So, I guess going back to kind of like the differences between like when you started and moving on, because I've always the thing that I always come back to. Well, first of all, part of it is about like technical analysis, right? Like, what is technical analysis and what is it not? Are trend following and momentum strategies actually technical analysis? But then like kind of what I realized was like, we're all trying to do the same thing. We're all trying to take a 1 minute chart of a single asset and then trying to predict the future from that one data series. And the thing that I continually learn is like, okay, that one particular thing, you're probably not going to have very much success with that, because like all of the edge that maybe there ever was in that, if there ever was any, is gone. But you change any one part of that setup, and now you start to get into some of the strategies that we know are profitable. Like, okay, you're only using one data series, so use multiple assets, and that's where you get some statistical arbitrage from. Or you're doing it over a huge universe of assets, and that's where a lot of these portfolio strategies are. Or, don't run it on 1 minute bars, because it seems to me that, these strategies where you really win big when you do win, that you have to let those be able to run for several days, weeks, months to really catch the win. And so like doing it on 1 minute charts doesn't really make sense. And so are there kind of shifts like that you made that kind of led you more towards, here are the things that you can actually run a fund off of?
Yep. I mean, you make an interesting parallel here or interesting argument about what is technical analysis. I mean, I started out with all the technical analysis stuff. I read all the books, I tried all the things. The problem with technical analysis is there is no definition of it.
Yeah.
I mean, there's a lot of useful things there. A lot of things started out in a really good place. I mean, I would say the quant finance field owes a lot to technical analysis.
Yeah.
But for some reason, technical analysis, or part of it anyway, they wanted to stay in the past and not move forward with technology, with research. And there's too much of a cult of personality in terms of, like, famous person X did something back in the 60s, 70s, 80s, and therefore that is by definition the right thing to do, and we have to keep doing it.
Yeah.
Well, I mean, first, markets change. Market structure change, price structures change, all of these things. But also, these people, they did what they did based on the tech and the research they had available. That doesn't mean we need to replicate it now. We have a whole different tool set now. I mean, why stop at those things? I mean, why are we drawing lines in a chart or using, I don't know, Wilder smoothing methods, which is clearly developed for pen and paper because, you know, we didn't have computers available or didn't have them accessible in a way the way we have today. So yeah, you need to do much more. And much of technical analysis is too simplified. It doesn't answer the whole question. Like, for me, it's usually about you buy when this and this happens. That's a small part of the portfolio. And I don't just mean that you buy and sell and you have sizes. You have the whole portfolio interaction. It's a much bigger picture, and maybe even interaction between portfolios. It's a much bigger picture than traditional technical analysis.
Yeah. Well, I've always found it interesting, like the research that I read about these things is much more focused on the universe and portfolio selection than it is on the entries and exits. That how to, like, do a multi-factor analysis of the different instruments and how they're correlated, so that you don't end up with a position that is actually more risky than you realize because these two instruments are correlated, right? And that a lot of the edge is derived from that. But I also very, very much identify with this thing that a lot of the technical analysis was just too simple. And, like, we have these really sophisticated tools now. I really don't see how anybody's going to have a lot of success in the trading world without doing some sort of back testing. I'm not saying that, like, your strategy has to be back tested. I mean, I think that it's better that way. But, you know, there are sometimes your ability to, like, see something and take advantage of it kind of outpaces your ability to, like, prove it empirically, right? So from there, like, how important of a role does, like, the back testing and the past data play into what you do? You know, how often do you go into a situation where, well, we want to do this thing, we're pretty sure that this is work, even though we can't completely prove, you know, what the performance of it's going to be?
I mean, there's this old expression, right? That I never saw a back test I didn't like.
Yeah.
You can always, I mean, if you torture the data long enough, the data will tell you what you want it to tell you, right? It's a matter of just hurt the data until it says what it's supposed to say. Backtesting can be a dangerous thing as well. I like backtesting, but sure, you run the same backtest over and over again and change the parameters, and sooner or later you get something that looks great.
Right.
Doesn't mean it has predictive value, predictive properties going forward. Yeah, I believe backtesting done right is valuable. It doesn't mean I expect the same thing to happen, but it gives me some sort of basis for decisions. Is there a value in something or not? And not just does it make money or not, but does it perform? I mean, what kind of profile does it have? How does it correlate to something else? I mean, are you building an absolute or relative strategy? Matters, of course, but if you're building a relative strategy, you need to understand how does it differ from your benchmark, what to expect in different type of markets. There are a lot of details to look at, not just some statistics at the end. I look much more at the day by day and week by week, what happens over time. I want to see the profile, the personality of a strategy.
Yes.
But,
so that kind of gets so that makes me think about what you were telling me about with your business, because so he's got a website. What is it? GetHush.app. And I went and took why don't you tell them a little bit about what that is? Because I thought that the options that you had in there was really interesting.
Sure. With this new startup is an American-based startup. We are primarily targeting young people across America with limited means, as in non-millionaires at least, people who have very little access to proper asset management. At the moment, they have few choices. I mean, they can go on Robinhood and gamble, which I think is a very, very bad idea for the vast majority of people. And Robinhood, if you want me to say something different, you can get my bank account somewhere, and I'm sure you can afford to pay me to say something nicer next time. For most people, gambling on stocks or options, derivatives, crypto, whatever it is, doesn't make any sense. The vast majority of people do not perform with that.
Yeah. Futures trading is, they always say futures trading is not suitable for all investors. Well, I would say it's not suitable for most investors. Like the reality is, to have success with it, you have to dump like your whole being into it. And you're probably not going to get that much out of it. Like, I would only do it if you really, truly love it, right? And there's definitely this gap where, like, I see people that, especially people that are into the six figures, but they're not, making millions, where, people have room to take on more risk, but they don't necessarily know how to do it in a productive way, because you go and you day trade, and it's kind of like, well.
Yeah, and it's even more so with options, especially when people use options just to gain leverage. It's just gambling. I mean, the old joke. I fear the Greeks even when they bring gifts. And that's very valid with options trading. I would be very careful there, in particularly using options as a cheap leverage. That's not a good idea. There are easier ways to gamble your money. So anyway, with this segment we are targeting, the point is that they have this kind of stuff, or they are very much underserved with proper asset management services, something responsible, grown up, reliable. Mostly because who wants to manage small amount of money? I mean, nobody with a decent background. The big banks, fine, but they group it together, they put it in 1, 2, 3 ETFs and call it a day. And that's not a great way to manage your money in the long run. So we are trying to create a very, very cheap way to manage your money long term. In a diversified, responsible manner, we invest in stocks, bonds, and alternatives, and we use a momentum-based algorithm to move money towards where the interesting stuff is happening. So if you have a bull market somewhere, at the moment, of course, the U.S. market is much stronger than most other markets. That means more money is moved into that. When that shifts, the money is moved towards something else. We're always invested in everything, but it's a matter of how much we invest in each thing. So we just want to be the cheapest and the best out there with a very, very simple, extremely simple app where you don't have to know anything about finance. You're on board, you click how much you want to invest, and you're done. It's no fancy terminology, nothing difficult in any way. It just works.
Right. And so when I was looking through there, it seems like you had like different flavors of the strategies. So that's where you're saying, like, I want to know how, I don't want to just see the end result. Because, like, well, okay, if you're in stocks, like, they typically draw down 20 to 50% just on the index, right? There's a journey on there that isn't always told by the end stats. So with those strategies, what are kind of sort of the things and metrics, like, goals that you're trying to hit?
I mean, what I'm trying to do is create a superior risk-adjusted return. Risk-adjusted being the key word here, right? I mean, if you want the highest possible return, you also need to take the highest possible risk. That's what a lot of people out there are not fully grasping. I think your audience probably knows it better than most, but there is always a strong relationship between risk and return.
Yes.
A bit of skill and hard work, you can tilt the equation a little bit, but you never get free return. If you want to crank up the possible return, you have to crank up the risk. And you crank it up too much, you're in the land of gambling, and it's not where I want to operate. And this particular product, now we're targeting people with long-term savings. They want to build their money over time. They're not looking to double their money next year, because if you do that, you have to be prepared to lose everything. And I'm not intending to lose these people's money here. So I'm going for risk adjusted. Now, of course, you can have multiple flavors within the realm of sanity. There's a pretty broad span of, say, risk levels, but the key thing I want to achieve is the relationship between risk and return have to be very strong. Now, you can never outperform, if you have a diversified portfolio, you can never outperform the strongest component in the bucket, right?
Right.
Right now, S&P 500 is one of the strongest things out there in traditional finance. So, of course, if you have a diversified global portfolio, well, of course, you're not going to keep up with the S&P 500, not in an extreme bull run. But, extreme bull runs, they last for some time.
Yeah.
We're now in the longest running one in history. And is that a true statement? I don't know.
I don't think it's the longest run, because I mean that run in from 2008 until the pandemic, if you want, depends on whether you count the pandemic. One of the things that I've had a hard time with in the post 2008 markets is that I think that a lot of our benchmarks and stuff like need to change. Like it seems to me that there were many financial panics between 2008 and COVID but because we had so much liquidity, interest rates were so low, the market just kind of glassed over them. Like there was that whole Euro panic thing.
Oh, yeah.
So, but this bull market in particular that we've had since COVID, and it hasn't been across the board because there's a lot of stocks that peaked in 2022. But especially this past year, like the percentage gain, I don't think we've ever had something that is this fast and persistent.
Yeah, scary, isn't
it? It really is.
I'm not one to call tops. I never try to call a top or a bottom because, quite frankly, you're almost always wrong with that. I get nervous when I see this strong bull market lasting this long because things always change. I mean, the few of us, or those also been around for long enough, know that there's always going to be something that happens that changes everything.
Yeah.
I envy sometimes the younger crowd, the newer traders. The ones who have only been in the market for like 4 or 5 years. For them, they have the attitude that this is going to last forever because it lasted for their entire life as far as they're concerned, right? Not the entire life, but their entire life in the markets. And I envy that sometimes. Old guys like us, like me in a way, we get cynical because we have seen, the horrors of the horrors of the horrors of war, the horrors of financial war. Yeah.
Well, this goes back to what you were saying earlier about that. You to get a higher return, you have to take on more risk, and what tends to happen to you is you get older and you've seen more things. You're aware of more risks, and the amount of risk that you want to take goes down, as opposed to somebody that hasn't had those experiences. They'll just do absolutely degenerate things and not realize how much risk they're taking on. And so there's a certain extent at which being naive, at least in the short run, it really helps you. And you get a lot of people that don't really know what they're doing, making a lot of money.
That's exactly what I mean.
Yeah.
That's exactly what I mean by sometimes I envy the young and naive because they have no idea what minefield they're on. They're taking crazy risk and they're getting away with it. And I wish I could do that. I'm just old and cynical, and I know the dangers, so I'm not taking that kind of insane risk.
Mm-hmm. Yeah,
but I've been there back in the 90s, right?
Well, and it's a whole question of like how much risk is actually optimal to take on, because for some of these strategies, like I'm totally okay with taking on a lot of risk and doing something that has a fat tail if I think I can avoid the fat tail. And that kind of can be a little bit iffy because you're usually there's not some technical way that you can predict the fat tail. That's exactly why they're fat tails. It's like nobody sees them coming, right? But then I often find myself, and I'm like, well, you know what, Seth, you do need to take on more risk. You need to do more things. Like, if you really, really want to have, like, you really want to go outside the norm, you have to take risks outside the norm. And this is where it's like, it kind of seems like there's this space. And that's why I really liked your book, Following the Trend, because it was kind of, you know, you weren't necessarily saying like, hey, you can go and do one of these strategies on your own. I think in the book you kind of are telling people don't do that. Like it's better to manage other people's money. But it did kind of make me start to think like, okay, maybe there is this space where you can take on more risk without being a complete degenerate, you know, and you know, fill that void where people they want to take risks. Maybe they don't want to start a business. It feels to me like if you really want to take risks, that the best way to do it is to start a business. But I digress.
Yeah, that's something I usually push. And also, by the way, let me explain one reason I think my first book was so careful, and probably a reason why it became popular as well. I wrote most of that book when I was having a bad year. So I was in a drawdown most of the time while writing this stuff, right? I mean, you run a futures fund, you will spend sometimes a year, sometimes 2 years in a drawdown. It turns around. Then you get this crazy runs up when you least expect it. But I was writing most of it when I was in a drawdown. So I was careful. I mean, I was not saying, go do this, you're going to make $1 million tomorrow, right? I was rather the opposite. And that's because my mindset
was this, what year was this? Like 2018, 2019?
Ooh, let me see. The book came out in 2012.
Oh, okay. This is much older than I realize.
Yeah.
But I think the one that there is a new edition because there was stuff up to 2020 in there. Yeah.
Let me see. That's the old copy. That's the 10-year second edition after 10 years.
I gotcha.
Yeah, I mean, what you're saying here as well with starting a business. Yeah, that's a point I'd like to make, that as a trader, if you want to trade for a living, then making the decision to trade your own money only is, for me, a bad trade. You already made your first bad trade decision by deciding to trade your own money for a living. The reason for that is, if you trade your own money for a living, and only your own money, all you do is trade your own money, you take all the downside risk. It's all your risk, completely your risk, and you have a very limited upside. And I say limited upside because forget about doubling your money every year. I mean, yes, we had a couple of good years in the markets, but on average, in the long run, if you can hit 10-12% over time, you're already really, really good. So do not expect you're going to do 50, 60, 100% a year over time. Any given year, fine, but over time it doesn't work.
Right. I think a lot of people's expectations are a little weird. Like I always hear this stat that like 90% of hedge funds underperform the index, but it's like most hedge funds are not trying to outperform the index. Most hedge funds are just trying to provide diversified income. And
I would say if you're trying to outperform an index, you're not a hedge fund in my view.
Yeah. Oh, well, there you go. This is true. Well, you're maybe a similar kind of vehicle, but it's not really a hedge strategy. Yeah, I get you.
But okay, so compare the two options here, right? So you think you can trade, fine. You want to be trading for a living, fine. I'm with you so far. And now you decide you trade only your own money. Well, first, as I mentioned, you have the unlimited, well, not unlimited, but you're taking the full downside. You'll risk losing all your money, right? On the upside, it is somewhat limited in the long run. You have an upside, but it's not unlimited. Now you need to live off something, right? So you need to take money out. So when you take money out, you take it away from your portfolio and thereby reduce your potential upside because, well, you need the multiplier, the percentage multiplier on your portfolio. It's a very stressful situation. You will be forced to take more and more risk because you need to get paid. So bad situation. On the other hand, let's say you decide to raise some money, get the proper regulatory approvals, whatever you need in your jurisdiction. You trade your own money and somebody else's money. And now you charge a fee for that. Suddenly you have a base income. You have some sort of security. And it's not free money, but it's safe money. Right? Because you work for it, but you know what you're going to get. Now you can pay yourself something. You don't have the same pressure to go for crazy high returns and thereby crazy high risk. You can still manage your own money. You also have the multiplier on other people's money if you can charge performance fee. let's face it, the real money is in performance fee. That's why hedge funds are hedge funds. So now suddenly you have a nearly unlimited upside for doing the same thing with a very limited downside. So trading just your own money for a living is by itself a bad trade. Unless you have a very good reason for not being able to trade other people's money, and I don't understand why your dream should be to trade your own money for a living.
Well, I feel like that for most people that the reason is they don't know what's involved in it. I mean, there are regulations and things, but those are hoops that you can go through if you have a really good strategy. I'm wondering, because one of the things that I hear a lot about is, people criticize these funds that they're taking a performance fee and all of these sorts of things because they say that they're not really giving, the investors back, that investors really aren't getting their money's worth, and you're just finding an easy way to live off of their money. How across the industry, how fair do you think that criticism is?
Well, I'll say it's very fair. It's not a universal thing, but first you have to understand that there is no proper definition of a hedge fund.
Yeah.
Anything can be a hedge fund. There are hedge funds with tens of billions of dollars, with hundreds of people, and there are hedge funds with two guys in the garage managing $100,000. There's no definition. A hedge fund basically is something that is either not regulated or very loosely regulated, that probably, hopefully, is not relative, is absolute, probably. But then again, we see more and more hedge funds that are basically just taking beta risk. It's just enhanced relative strategies. So anybody can do anything there. So of course, if you have the ability to raise money, it doesn't mean that your strategy has to be great. Many hedge funds are not great. There are excellent hedge funds out there, and there are lots and lots of bad ones.
Yeah.
And the key, I know this is not what traders want to hear, but the most important thing to start a hedge fund is sales.
Yeah.
If you can't raise the money, you're dead in the water. If you can raise the money, then your strategy is secondary. Having a good strategy is good, but raising the money is what matters.
So for the ventures that you've done, how did you overcome that hurdle? Did you get good at raising money, or do you rely on other people to help you with that? That's an area that really interests me.
The initial part, and it's always the most difficult thing, is always your first fund and the first time.
Mm-hmm.
Imagine going out to people and say that, trust me with, 50 million, 100 million.
Yeah.
I got a great back test. Don't worry about it. I got this.
Right.
Good luck. Now, it depends on who you know, what your connections are, and, all of these things, and how much you're willing to work for it. And for hedge funds as well, you're generally, again, depends on jurisdiction. I'm not giving it legal advice and so on, but generally you're not allowed to approach retail.
Right.
You can only get investments from qualified investors, which in most places means that you can only talk to people who have 2 million plus in liquid means, investable means, not counting real estate.
Right.
So starting out the first time is most difficult. And what did I do? So again, back to my initial journey, I transferred, as I said, from my job in Stockholm. I transferred to Geneva, Switzerland. And yes, those are two different countries, Sweden and Switzerland. Sorry about that. As a European, you have to mock Americans geography classes a little bit, but you can mock my accent, so you can get back on me on that. Anyway, I found myself in Switzerland, Geneva, a French-speaking town. My French was pretty bad. It's still.
Oh, I gotcha. Yeah, okay.
It's still pretty bad. I needed to get to know people. I joined a technical analysis organization, actually, that required members to get to know local people and get sponsored for membership. Not sponsored with money, but just people to sign a paper saying, yeah, we know this guy, he knows what he's talking about. I mostly did this to force myself to get to know local people. So I sent some random emails to people on the membership list. And one of them, the first one who answered, the first one I met, I went to meet him for a quick drink in Geneva. And after like 20 minutes of talking, he mentions that, well, he's got like 50 million he needs to have managed. He doesn't know what to do. He wants to set up some sort of fund vehicle. And do I know anything about this?
Wow.
Of course I do.
Oh,
Let's go research.
You really lucked out.
Yeah, I mean, this is one of those things. That's why I feel like I'm not competent to give advice on how to raise money for your first fund, because I got ridiculous lucky. It's just beyond words how these things do not normally happen. But anyway, in the end, that's the whole thing. That whole thing ended with all kinds of lawsuits, and it was a very messy breakup, like 5-6 years later. But at least at that time, I was in the business. I had a track record. I had managed a fair amount of money for some time, and if you're inside, you're inside. So how do you approach this otherwise? Well, I would say you need to do something that stands out. And the wrong way to do it, I would say, is the traditional way of running back tests until you have a Sharpe ratio of 7 with an annual return of 55% and a drawdown of 3%. And anybody can do that. Do something that the other guy didn't do. Obviously, I can't tell you what, because that's the whole nature of it. You need to do something that stands out, something that makes you notice. I mean, whether that is, I don't know, starting a blog, a newsletter, being visible somehow, showing that you know what you're doing. Generally, I mean, that's general rule for achieving something in life, right? I mean, you got to show that you're willing to do something the other guy is not. And that's a personal thing.
So now another question along the same vein. It seems to me like the industry is changing a little bit because, especially in my LinkedIn network, it really seems like a lot of people are shifting towards the family office model as opposed to funds. So what's with that? Is it really shifting, or?
Well, okay, first you've got to explain yourself. What do you mean by the family office model? And I say that as somebody who's managed family offices for a while, but what does it mean?
So my understanding of a family office is you've got one guy or family that is a high net worth individual, like they have 25 million or more in assets, and you're just managing their assets, and that it's cheaper for them to hire a little office to manage their money than it is to go and give it to a hedge fund. And maybe part of that might be investing in multiple hedge funds, but having your own organization that's run just for you. And that was kind of my impression of what that field was.
I would say, so I worked with or for a few different family offices, and I see very little in common between them. That's why I'm not sure what family office model generally refers to, because I've seen, say, one family office. I can't name any family office names, so obviously for obvious reasons. And fun fact, in Switzerland, if I talk about my clients, I can possibly go to prison for that. So that's an interesting situation. Anyway, say one extreme is a family office I used to work with where I have no idea what the family is. And I worked very closely with them. All I know is they've been around for 200 to 300 years. Mm-hmm. The original guy had a brilliant idea, which, by the way, it's a great way of doing it. He realized that one day he's going to die, somebody's going to take over. He does not want the family fortune to be destroyed. This guy created the fortune somehow, industrial business of some sort, I gather. He set up a foundation where the family have absolutely no say in what's going on. None. They get a certain percentage of returns distributed. They have funny little rules like, bear with me, this is a few hundred years ago. Like all education is paid for by all male descendants. Yeah, 300 years ago, nobody had the idea of women going to university. And the thing is, with those things, with these foundations, the rules cannot be changed, ever. The rules are there for a reason. The rules are there to make sure that the fortune will never disappear. Now there's a whole organization that's, 30, 40 people working with managing this. according to certain rules, according to certain guidelines that were set a few hundred years ago. So another family office I've been working with, they manage quite a few billions. I know very well which family it is, and they have a very large organization. They have their own building with lots of people. There's nothing in common. I also know smaller family offices where you have like three guys in a room, where one of them is the principal with the money. Sometimes the family is involved. Sometimes the family is not even allowed to set foot in the premise. They just get their paycheck and that's it. They just get a cut and that's it. So there's very little in common. And say proper family offices are usually, say, on the small side, 100 to 100 million. It would be the smaller side to set up a family office.
Yep.
But they're very, what's the term? Very heterogeneous. So setting up a family office, I would think, is starting to become attractive once you have, for one reason or another, accumulated a few $100 million. Before that, you're probably better off investing in various things or having proper people, maybe even employ people, but generally you need a bit more to set up your own family office the old school way.
Yeah, I gotcha.
But anyway, sorry, I digress. I wanted to catch something you said before about how the industry changed.
Yep.
The industry changed a lot, and a lot of people outside have not really seen how the hedge fund industry has changed. So from the time when I wrote my first book to now, so much has changed. Back then, if you talked about trend following and futures back then, it was like this new cool thing, and anybody can kind of start off a shop with. You start on a small scale with, most people started with like, 10 million or something. It's not profitable to manage 10 million bucks. That might sound odd, by the way, to somebody not in the business, but managing $10 million is not profitable. It's not worth doing for the money, but it's a starting point if you're willing to like work without a salary and build something. But you could start with that, and you could raise a bit money here and there, 100,000 here and there, and build something from there by just doing something new and cool. Nowadays, it is very, very much a marketing game. So money consolidated with larger players. Large hedge funds get more money. It's like, I know I probably said this in a few interviews in the past, but it's selling a hedge fund today is like if you have invented a slightly better toothpaste than Colgate. Right. You created a little bit better formula, right? You can prove that your formula is better. Now what? You gotta go market to consumers? No. You're gonna go to Walmart or the bigger supermarkets, and you have to negotiate for shelf space because it's all brand recognition. And how much money do you have to put out Super Bowl ads and plaster your logo everywhere? It's a matter of consolidating money to the larger funds, and it's very, very difficult for small funds. A small fund is like $500 million fund is a small fund. So sales and marketing and brand recognition is in a way more important than the strategy these days. That part changed a lot.
I gotcha. So a lot of it was because of the industry consolidating. People started to branch out into related areas essentially, and taking the innovations with them to other areas.
It's not just innovation. I mean, it's like 10, 15 years ago, you go talk to large institution and you tell them about trend following and how we can trade these different things in the same way, and how we use futures to access lumber and palladium and stock markets, and how this evens out in the long run. And it's like a new concept. Like, oh, cool. Yeah. Put some money in that. Nowadays, the response you're most likely to get is like, yeah, David Harding is managing $50 billion. What do you manage?
Yeah.
It's like,
well, and there's also, I kind of noticed that there's also a little bit of like, I don't know how to put it, but like the performance of momentum is well known, and there's a lot of question now about like, is it actually sustainable, right? Like before COVID, there was a lot of people that were really convinced that like it doesn't work anymore. They said it was dead. Then COVID came along and it outperformed, But then since that time, it's kind of gone dead again. And one of the things that I look at a lot, because in my trading, it's all about the flows. So I want to know, there's all the different types of funds. How much money are they managing, and how might they be allocating money into the markets based on various strategies? And the CTA space in particular just grew so much after COVID that it seems to me that there's not as much room as there was, because they're managing too much money that maybe the alpha on it is decaying, right? What's your thoughts on that?
Well, I mean, first, trend following has died more times than Mark Twain, right? I mean, this happens every few years, but the same thing happened after 2008. So 2008, for those of you who traded through that year, I'm sorry for you. I was there. I feel your pain, and thank you for your service. That was a bad year. We all suffered. I mean, even us on the CTA side, we made good money. That was our best year ever in managed futures, but it was still the most painful year ever. There was properly in the trenches, that year, when you don't know which bank is going to blow up tomorrow. And horrible year, but returns were amazing in the end. Now, after 2008, everybody and his grandmother started a CTA fund. We had trend following funds popping up everywhere. Then, of course, the same thing always happens. People come into a strategy like anything else, like any industry, any business, Once
they all get in at the wrong time.
Yeah, everybody comes in after the good year. So everybody joined in 2009. Hedge funds started CTA trading or trend following futures trading everywhere. And of course, we had a couple of bad years after that. And then many of them were knocked out. This cycle keeps repeating. I see no reason to think that trend following or momentum has died, or, I mean, okay, returns went down on trend following, but there's structural reasons for that, different ones.
Yeah.
Mostly the interest rate situation. I don't want to go into too much of the boring details, but in the long run, trend following benefited greatly from the fact that we started out with a very, very high interest rate and slowly moving down, which, well, being long bonds and long money market instruments during that time was
a really beneficial,
a big part of it.
If rates don't come back down and go back up high, then that could be a problem for them, those strategies, essentially.
Sure. I mean, I'm not expecting returns on trend following to be the way they were in the 90s or 80s. Those were brilliant years. I mean, you made money on the same thing twice. First,
right.
You made money from the fact that bonds had a never-ending rally. And on the other hand, we had high interest rate, and we only need 15-20%, depending on your point of view, on in margin requirements. The rest of CTA fund is in cash. What do we do with the cash? Put in short-term money market. And so you get free interest in that as well. And the best part with that, you get paid performance fee on that.
Oh, there you go.
So imagine back when rates were like 8%, 9%, and you have 80% of your fund liquid. You put that in government papers, you have a free return on that, and you get paid performance fee for that. Now that's a good game. Those were the days. I was not doing this in the days when we had like 8-9%. I came in after that, but still, those days are not returning anywhere anytime soon.
Yeah, so that's interesting. So there are some reasons to believe that the performance would change, but it also sounds like you don't believe that the CTA space has gotten so big that itself is causing the alpha to decay necessary.
No, I don't think so. I mean, obviously, there's a lot of bad CTA funds out there. Not a big surprise. I mean, any profitable sector will attract lots of players, and most of the time, only a small percentage are really good at what they do. That's not a big surprise. But I mean, we see some CTA funds, and for regulatory reasons, I don't want to name any particular funds here or investment opportunities. I'm not endorsing or the usual disclaimer. But there are clearly some stellar CTA funds out there that have been around for, I mean, some of them is like 30, 40 years. And they're still doing well. I mean, that's quite some track record, and they're still performing.
And at the time, nobody thought that they would last that long. Like the thing that's interesting about it is that I think that there's enough research, especially on the market microstructure side, to suggest that the market inefficiency that momentum takes advantage of is really structural to the market, that it's because of the rules of the market and the way that things work. So that would be something that unless you change the rules, and you would really have to drastically change the rules where you wouldn't recognize markets anymore, that will always be there. And then the question is just, okay, but like maybe only so many people can take advantage of it, right? It'll always be there, but it's still competitive. And have you reached a saturation point? And so that's always kind of the argument is like, have we reached a saturation point? And well, nobody knows, but
there's not an interesting side of this. I published a few times in the past models that take advantage of exactly what you're talking about.
Yeah.
So if we assume here, which is a reasonable assumption, that there's a lot of money, probably too much money in trend following. If you further assume that most people in trend following do more or less the same thing. I don't know. I think I read that in a book somewhere. So if we make the assumption, we can more or less predict the stop loss points for the major funds. Sorry, excuse me. And if we can predict where the bulk of the trend following funds take their stop loss, we can take advantage of that. So I published before a type of model where I tried to predict the stop point, and I assume that when they stop out, they start triggering each other's stops. Like they have a footprint. It's big enough to move the market in short term. So
absolutely.
And if you predict where you think they're going to stop out, then say you measure that we're in a bull market. How much drawdown in the bull market do they need to stop out? Now you put a buy order a little bit below that. If it hits, you wait for a bounce up, and you take a short-term bounce up, because normally what would happen is a lot of them take the stop at the same time. They push the price further than it should.
Right, and then then there's the post meta order regime change, essentially.
Exactly. I mean, this is not rocket surgery. It's not that complex stuff, but you can always do these things when you think an industry goes too big. If you can predict what they do, you can try to fade their action, take the other side of it.
So this was actually one of the things I wanted to ask you about that interested me the most in the book was because I've always heard guys talking about, like, to what degree do you want to have momentum versus mean reversion? And the advice that I had always been given was that you want to incorporate some amount of both of them in there. And the way that you showed mean reversion in the book was like an ATR stop. Like you take the average true range and a certain multiple of the average true range drawdown from the highs is where that mean reversion sort of thing starts to come, is in that particular model. So is that kind of similar stuff to the things that you'd published?
Exactly, stuff like that. Yes. I should mention as well regarding ATR. So ATR is a very common technical indicator. It's a rough gauge of market action or volatility, if you like. Depending on how deep you're into finance, you might be various degrees of angry when I call it the volatility indicator, but yeah, more or less.
That's how I use it. I use it as a volatility indicator.
So on the institutional side, ATR is not common at all. I use ATR in the book mostly because it's so much easier to explain and to replicate by people who read the book. Exactly. In most cases, it doesn't make that much of a difference if you keep things simple, which I try to do in the book. For this particular use case, it doesn't matter if you use ATR or standard deviation. I prefer standard deviation, as do most people in the market, because you can use standard deviation for a lot more. It's a much more versatile analytic.
Okay, so when you say standard deviation, are you talking about like standard deviation of daily range, or just the closing price, or?
Well, you got to adapt it to what you're trying to do, obviously. But normally you would look at standard deviation of returns, or price returns, percentage returns.
Yeah.
The price or percentage, depending on, again, what you're using it for. Always be sure you know you use an analytic for a reason.
Yep.
If somebody says you should always do it this way, well,
Yeah.
probably not. It depends on what you're using it for.
When I hear standard deviation, that's one of those ones that in the retail trading space that like I know, like red flag, because the most common application of standard deviation is Bollinger Bands, which is the standard deviation of closing price essentially. And I really feel that it's kind of a misapplication of it because it's a non-stationary series.
No. It's not. Let me see. I haven't used Bollinger Bands in ages. John is a great guy, by the way. I usually meet him at various conferences. But no. The standard deviation in there is, I believe, it's been quite a long time, but it's standard deviation of the price changes. Otherwise, it doesn't make any sense. I mean, if you do standard deviation of the actual price, or like if something is trading at 100 and goes up to 102, and you run standard deviation on the price on the close series, it probably makes no sense for using it for anything. But no, I mean standard deviation. Okay, yes, you always need to have a somehow limited range, right? It's
exactly. It has to be a stationary series. Yep.
Yeah. Again, everything for every tool, you need to have a toolbox, and you use the tools for specific purposes. That's why I never understood the whole, is this indicator better than the other one? I don't know. Is a screwdriver better than the hammer? What are you using it for?
Well, there's
standard deviation is excellent depending on what you need it for.
When retail traders are asking that question, it's really like, well, somebody taught something, but I have no way to verify. Like what's the actual data? And it's difficult because sometimes you might be able to prove like a particular statistical property of the market and not necessarily be able to prove a particular profitable strategy based on that property, which is a lot of the things that I see. But then there's a lot of things that I see that they have, like the most popular thing in the retail trading space right now is price action, which again, like another really vague term, but mostly what they're doing is they're either doing like candlestick patterns or they're doing support and resistance, right? They're looking for places where it bounced before and marking that as support and then trying to trade mean reversion between those. And that's all fine and dandy, but the problem is that like we have no evidence that it works. I can back test like a strategy that seems to be doing what they say it's doing, but then they'll say, oh, that's not actually correct, or whatever the deal is. And okay, so then like produce the empirical evidence, and they can't. And some people, what I find is that they eventually get to the point where they're like, well, empirical evidence doesn't matter because it wouldn't be good data anyways. And well, so then how was anybody else supposed to verify or know I should do this or that? There's no way, right?
Exactly. How much money would you have used? How much money would you have made if you did it a different way? You need someone to compare it. So, okay,
exactly.
So you used a certain method to trade in a bull market. I don't know. You made money, fine. Would you have made the same money something else? Did you make money because of this indicator or despite of it?
Yeah.
I say the same whenever I haven't heard people bring it up in a while, but for a while, people started approaching me about Elliott waves. I guess they realized that it's a good way to wind me up a little bit. The whole magical thing that controls the universe and how this supernatural numbers, if you divide them a certain way, they show you the future of the world, and you can predict the universe in so many decimal certainty by the whole thing. Yeah. I don't know how many, 5 waves up and 3 waves down and so on. You can fit this pattern to absolutely anything. And once in a while they come up saying, well, famous person X made money doing this.
Yeah. Okay.
First of all, I have no way of verifying if that is true or not. None whatsoever. And neither do they. And second, did this person make money because of this or despite of it? I've always said if somebody can show that this, I don't know, what is the number, like 0.7 6 2 something, or is it, I don't know, something like that. This Fibonacci ratios they use in conjunction with this. If somebody can show that this has a higher statistical significance than about 2/3, then fine, show me the statistics. But I see no use for those kind of things, and I've seen nobody ever being able to show anything that even hints at a statistical significance. But sure, bull markets, people make money.
I find it so interesting that you chose Elliott waves. So okay, let me give you some background on Elliott waves and what I've found about Elliott waves. Okay, so I did a little survey where I put a survey up on Reddit to see like what methods are retail traders using. So that's how I know that like the majority, and it's like 60% of retail futures traders in particular. I had all sorts, but most of them were futures traders. Are trading what they call price action. But the one thing that they all said I explicitly don't use, like I don't think works, there was like the one thing that retail traders said they didn't use was Elliott waves. And it was by like a large margin, which I thought was really weird because I never hear people really talk about that on online forums and stuff. Well, but there is something that I know about short-term markets that does kind of suggest to me that like Elliott wave theory, that they were perhaps making real observations. Not that it would be like a profitable strategy or anything, but when somebody comes in and executes a large order that, is too big to execute all at once, it's going to move things, right? And what they do is they will push it just until the point where like the liquidity gets strained and then back off. Because if they do that, it kind of creates this hole where like price will stay in there for a really long time and you can't execute as aggressively in that location, but it stays there for so long that you end up getting like, just as much filled in that period as when you're executing aggressively. And so it will create these, so this kind of like, moves and then there's a pullback and like bull flag sort of a pattern. There is some reason to believe that because of the way that large institutions execute, that you will see those waves. And if it's a really big one that lasts all day, you will often see 3 waves. But like the whole thing is you don't know how big the meta order is. So like if you see one wave, that doesn't mean that you're going to see another one. And so that was, a case where it's like they might have been seeing something for real, but it doesn't necessarily, they didn't have the full picture and it didn't necessarily result in a profitable strategy.
Yeah, but okay. So a wave, whatever you want to call it, right? So, okay, the market moves up for a while and it stops moving up and it moves up again. A wave? And besides, it's supposed to be 5 waves, I believe, up and 3 waves down.
Is it 5 waves up and 3 waves down? Oh, okay.
I believe so. It's been a while, but I mean, so all of the things, I mean, I'm not disagreeing with what you just said.
Yeah.
I don't see how that could create like 5 waves up and 3 waves down on some sort of consistent basis. I mean,
no. I think that they were seeing waves, and then the 3 and 5 thing was just overfitting, right? Was probably.
I think it's I don't know, UFO observations. It's like, okay, wrong time to bring that up. Just as I said it, I realized what's going on over there at the moment. But yeah, it's actually maybe it's not so wrong time. I mean, people see what they want to see in the sky. People look up and they see something they don't understand. They make up a story around it, and now the whole myth spreads. And I mean, 200 years ago, people kept seeing witches in the sky, and then later people stopped caring about witches and they start reading science fiction, and suddenly people start seeing UFOs all over, which nobody saw earlier. And UFO sightings are only seen, of course, in regions of the world where people are into science fiction, and there's almost no sightings ever in Africa. I'm not sure what the if we have racist aliens or what's going on there, or perhaps people were busy with other things.
Yeah. Well, I don't know if I can comment on that thing, because so much is happening and I've seen so much nonsense that I've completely turned off with because I'm always interested in UFO things just because it's entertaining, not that I believe in them. But with this recent spat, I've disconnected myself from that.
Sure. I I mean, the point being, people, if you look at something long enough, you will see whatever you're searching for. That's the point I'm trying to make here, right? If you think there's a magical pattern in the chart and you stare at that chart for long enough, you will find the magical.
You'll find the
It doesn't mean that it's there. You just stare at this chart for too long, and your brain is starting to make up stories. And now you write a book or two about it.
Yeah.
People follow what you wrote because, hey, it's in a book. It's got to be true, right? That's how these things start.
Well, and
of course you start a newsletter, and hey, there you are.
see, and that's kind of one of the things that I've been hinting at, and that I'm trying to tease out is like, okay, I see retail trading as kind of a cargo cult. Like, I think that they saw momentum traders in the 80s and 90s, and they were successful with that, and they wrote like the Jack Swagger books and all of those sorts of things, and so they read everything that those guys said and said, okay, now I'm going to apply it to my retail trading. And they didn't realize that a key part of the strategy is that you're running it on daily bars and you hold the positions for months and months and months. So if you're going to try and apply that to day trading, it doesn't make sense. And so it's like a cargo cult. They didn't really understand where the edge was coming from, what these people were actually doing. And so when you look at the things that retail traders do, that there's kind of this question of like, is there something fundamental that they're trying to do that doesn't really make that is just, wrong? Or is it kind of more just, well, there are some things that work and there are some things that don't work, and you just have to have a good enough process to be able to find the things that work and don't work? And my opinion is that there is something fundamental that they are doing that doesn't make any sense. So when I look at research studies, all of the studies that I've seen are like cause and effect sort of a thing. It's like, if we do this, then this happens. So there's a lot of studies that are like, if we execute it in this way, does that change the impact of it than if we execute it this way? But it's always, if we, the big player, do something, is there an effect? Whereas retail traders are kind of trying to do is like, if I see a pattern, is there an effect, right? Like there are empirical properties of the market where if you do something, the reaction to you is extremely consistent. But you can't just go and look for some pattern out there and then say that there's going to be some sort of predictable move after that, because the pattern that you're seeing is the result. The pattern that you're seeing is they're coming in and executing, and they're doing it away. And so by the time you see the pattern, it's complete. These guys are already done and out of the market. And so my take has always been that trying to use the past price to predict the future price on a short-term basis is in and of itself fundamentally flawed. And so the reason why the momentum has always been interesting to me is because that seems to be, something that falsifies that theory. And so when I got into it and I read your book, and then I realized, well, no, because it's a matter of time frame, right? The inefficiencies that you can see in the order book end up exhibiting themselves on the higher time frames in momentum.
So, I mean, when you say predict the future in terms of time series, I don't see what I do as predicting the future. I don't tend to predict the future.
Well, that's a good point, because the win rate of it is really low, right?
Yeah, sure. I mean, what I try to do, even I've been running models with a higher win ratio, and low win ratio. Doesn't matter to me. That's not an important factor itself. I'm trying to find a way to slightly and only slightly tilt the probabilities in my favor. And I mean very slightly. I mean, it's a matter of getting a little bit statistical edge, a small one. And then you repeat over and over and over.
Right.
Until the law of big numbers will give you money.
Yeah. And in this case, I mean with momentum, it's also like you're taking advantage of the far right tell, right? The edge is not in this happens more often rather than not, but when it does happen, the win is so big that it makes it worth it. So perhaps I could adjust it to just say that price is not very predictive of future price. Predictive, not very predictive, right? But it's still an open question. And it's kind of a funny one because the professional world is asking a completely different set of questions from what the retail traders are. And so it's kind of hard to show to the retail traders, well,
and of course, also on the institutional side, most of the institutional finance space is concerned with with relative return.
Mm-hmm.
Whereas a large degree of retail people have not stopped to consider which way they want to go. And don't say I want to follow the index or beat the index in a bull market and have absolute return in a bear market, because the world doesn't work that way. You need to figure out where you fit in the ecosystem, what you want to achieve here.
Yeah.
I mean, most finance is relative, meaning that you invest more or less like the index and you're trying to slightly beat the index. That means that if the stock market is up 30%, you might want to be up, 31, 32%. If it's down 20%, you should be down 18, 19%. You do a good job.
Yeah.
And that might sound crazy to people who are not in the business, but if you're a relative manager, you don't get to choose this. I mean, if you're working in finance, it's not like it's your choice what to do. You will have a very, very strict mandate what you can do or not.
Yeah.
I mean, if you're a relative manager, you will get a tracking error budget. I never had one of those. I'm not one who appreciate those things, but you could do very well in finance, managing mutual funds or something similar, and have a TE budget. That means you have a certain amount of deviation allowed from the index. And your job is to achieve slightly better. If you're 10 basis points better than the market is down 20% one year, you're down 19.8. You did a great job. That's how most finance works. Absolute return, meaning that I'm trying to make money, period. Market up or down, I just want to make money. That means that if you do 15% return and the market is up 30%, you did a good job. It's not your job to follow the market. If you absolute return, you're not chasing the market. You're supposed to get close to your target, whether that's 10%, 15 or 20%, whatever that is. But in absolute return, you should not care about what the index does. You're there to to beat the zero line and to reach your target return. Two very different type of strategies.
Well, and it's very true that I don't think that the most retail traders, because they're not thinking of it in that perspective of okay, here's this strategy and here's this strategy, and what is this one good for and what is this one good for in terms of the performance and the type of person that invests in it, and they don't necessarily know where they fit in that. I think that the reason for that is because most retail traders just want to be involved. Like to me, I'm okay if I can keep trading. I'm involved. I find that being there at the front line, watching the markets, I learn a lot from the markets, and that kind of helps my longer term things. I have a house, wouldn't be able to have owned a house if I hadn't learned everything that I learned from trading the markets and watching treasuries so long. I knew that people were going to come and there was going to be too many people trying to buy houses, and that the interest rates weren't going to stay low forever. So, part of it was luck, but I wouldn't, so to me, in net, I make money off of it, right? But most of the time, if I can keep trading, I'm happy. But, most retail traders, they're thinking, oh, I want to make money. And, if you're going to come in and you're going to day trade, if you're trading index futures, that's what's most popular. You can't expect to come in and just take a teeny tiny portion of the S&P's volatility and then outperform the S&P 500 on a yearly basis. It's just absolutely ridiculous. And the people that think they're doing that, the only reason they think they're doing that is because they're using leverage. But if they were using leverage to buy and hold as well, you'd find that they're not even anywhere even close to making what you'd make with the index.
Yeah.
Really, I think that the old way of day trading would have been market making strategy, where the goal is to make consistent income on a monthly basis, that the amount that you make per month is a consistent amount. But the overall return that you're going to make isn't going to be very much. It's probably going to be more like the risk-free rate of return, right? And so if that's what you're doing, then why are y'all in here trying to YOLO everything, right? It just doesn't fit up because they don't have a target. But at the same time, and especially for you guys that are like writing books and things like that, it does kind of give you a little bit of a target that's like, okay, well, so if they can tread water, most retail traders are going to be happy with that. They can tread water and they're exposed to the far right tails, right? That I think is like ideal sort of a thing for a retail trader. You get to continue doing, and every once in a while you can get lucky. And the problem is that most of what happens is it's the opposite, and they're exposed to the far left tail instead, and they think that they're doing well for about a year or two, and then they blow up.
Yeah. Pennies in front of the steamroller. Yeah, sure. That's a lot of strategies that look too good to be true are usually involve something normally called hidden negative skew.
Yep.
Basically, pennies in front of the steamroller. It looks super easy. Maybe it works for a long time, but sooner or later your hand gets stuck. Something happens that destroys everything, and you lost everything you made in the past few years. There are a lot of strategies like that, and they're not necessarily bad as long as you are very aware of what you're doing.
Exactly.
If you don't understand that you're trading something with a hidden negative skew, then you have a problem. But,
which is
let me tie back to something you said before that fit well with this. So we mentioned here you need to know where you fit in the ecosystem, what kind of strategy you have, and if you want to raise money, if you want to manage other people's money, which I very much recommend that you do. If you want to be in finance for a living, trade other people's money with proper regulations. But when you do that, you really need to understand where you fit. If your pitch is, trust me, I made a lot of money in the last few years, here's my track record, nobody cares.
This is probably not going to work. But people with that much money aren't going to invest on that because they've already done that.
Yes, I mean, your rich Uncle Bob is going to invest, but nobody else. But otherwise, the type of pitch, and this sounds more boring, but what you want to be able to say is, I do more or less the same thing as those guys over there. That's sector, that group of hedge funds, a group of mutual funds, those investment strategies. I do more or less what those guys are doing, but I improved it with this thing. I built this thing on top of it that should have a better return or better risk management, but I improved on this sector. Now you know more or less what you're getting. But if you just say, well, I doubled my money last year on my account, you want in, I manage your money too. Like, yeah, what are you doing? You're buying lottery tickets, you're playing blackjack. I mean, what's going on here? So you need to have explainable strategy if you want to raise money. And forget about the whole black box. It's too secret. I'm not telling you because nobody's investing in that. Those days are long gone. You can't be too secretive about what you do.
Yeah. See, I have to think on that a lot because, I've gone through an evolution of ideas. One of the things is that I've got my system of stuff that I've built because I basically, I had a little bit of insight into how things worked at the bank and so forth. And I was like, well, yeah, knowing what the value of the currency that you're trading in, that kind of is important. Knowing what the yield curve is doing, that's kind of important. And none of these platforms had that stuff built into it. So, I built what I felt like I needed to like just barely even stand a chance. And then other people wanted it. And so that's kind of turned into its own thing. But I've wanted to do a fund, and the original idea was, well, I don't necessarily have to do anything that's like too terribly innovative. I can just bring it to a new set of people because there's this whole thing with they're making a new test, and there will be people that will be able to invest in these sorts of things that couldn't before. But now the more that I think about it, the more that I'm like, well, I don't know if that audience is actually going to be that big, if the amount of money that would come in there would really be enough to sustain a business. And I'm not sure what would be a strategy that would actually be appropriate for that group of people. It actually seems to me that the whole like test, that the real audience for that is venture capital. Allowing people to basically fiddle around with venture capital is kind of the way. So I've kind of been adjusting and thinking about, but I really like the thing that you've been doing where you say, well, but we can invest in ETFs and we can give people, a different return that is in some ways superior, even if it's not outperforming the S&P 500, it's better risk adjusted returns. I I think that's really, really smart. And that's kind of had me on this whole thing the past week or two, like rethinking like, oh, well, what actually are the best opportunities for me to go into? So,
I mean, that's also one thing that I like to. I mentioned before on other interviews, but in my view, what many people are missing is that investment strategies on the professional side. I mean, if you go outside of you playing with your own money, if you're doing something on the professional side, an investment strategy is a product. It's not about the best possible strategy. It's a product.
yeah.
I mean, it's a stupid comparison I like to make, but say you want to make a car. You want to start a car company. The equivalent here of what people want to do finance is everybody wants to start Lamborghini or Koenigsegg if you're into Scandinavian cars. You know, you want to have the fastest, flashiest, best car because you think that's the best. It's the best proof of my skill to do the most crazy, insane neon colored Lamborghini. Yeah, how much money does a company Lamborghini make? I don't care if the car is cool. You're making a product here. You know, it's not a hobby anymore. There's much more money in Toyota, Kia. If you run a business, you need to make a product that you can sell to your target audience. And there's not that many people in the world who wants to drive a Lamborghini. Quite frankly, most people in the world will crash it the first 5 minutes because it's not easy to handle. But you need to figure out where do you fit in the ecosystem. And I mean, trying to go for the craziest strategy is probably a bad idea. Find a gap in the market, find what you can market, figure out what does your target audience, your investor base want? What's your investor base? Who can you raise money from, and what do they need? It's a product. It's a business.
Yep. Oh, and it's totally, I think, an ego thing, right? I think you're absolutely right. Like a lot of people come into trading because they just want to prove to the world that they're super smart and everything, right? When it's like, okay, but you could do something a lot less boring and probably be a lot more successful with it, you know?
You know, another stupid comparison, but it's like everybody wants to be the lead singer, guitarist up on stage. That's not necessarily the best trade to aim for that. I mean, wouldn't you rather own the recording studio, the record label? You know, how long time do you get up on that stage? Yeah, you're a cool guy for a little while if you get that spot. Not many people get up there to begin with. Now you have a limited time in the spotlight, and you're out. And hopefully you brought something with you on the journey, or you took something out of the whole game. But it's probably a better business to start a record label than to start a rock band.
Yeah. And see the problem that I see in the retail segment is that so often we know so little about what the possibilities are. You know, it's like, you know, it's kind of hard to discuss with somebody which direction they should swim when they're in the middle of the ocean drowning, you know, like they're just trying to keep their head above water, and they don't know what the possibilities are out there. Where can I go this way? Where can I go this way? So it's always like these situations where, well, you can do that. You know, there's some other things, like there are some places where I think retail can play in high frequency trading, but like it's a different game from what most people are doing. Like it's a really complicated thing. You're like really technical, and it's really hard, and probably you don't make that much. So like you can go that way, but do you really want to put that much effort into it? Versus you can, some of these more boring things are things that can actually turn into really big businesses, and nobody's going to sit there and go like, oh man, they're, you know, they figured it out. They're the one that mastered the market per se, but who cares? Because you're making money from it. Like,
I mean, do you want to be the guy who sits at home looking at the performance of mutual funds and says that, hey, look, these guys are horrible. They're idiots. I can outperform that. Or do you want to be the guy managing a mutual fund for $5 billion, making pretty good money and pretty good living, and you're fine? It depends on where you want to be, but you know, trading your own money and outperforming, showing you're outperforming somebody who manages $5 billion, it's a fun thing to say, I did better than that guy, but you know, in the end, he's managing $5 billion and you're not. The money is not always where you think it is. Yeah. Again, think in terms of products and what can you raise money for, what What kind of products can you manage? What kind of products are suitable? And I heard so many times, I got pitched too many times of various ideas to start variations of, let's open up for the general public to invest in hedge fund type of structure.
Yeah. Exactly my idea. Yeah.
I mean, first, I'm not sure if they want it. Second, I'm not sure if it's suitable for them, if they understand what they're investing in, if they can take the risk, if it's morally defensible, ethically defensible to introduce that. And then, of course, you have the other little issue that, so the regulators have banned this for a reason, right? There's a rule that you have to be a qualified investor, meaning a multimillionaire, to invest in these things. So, okay, let's say we figure out a way to bypass this. We figure out a clever way here to create some sort of structure where you're investing in this in a different way, and we say that it's probably allowed because nobody banned it so far. You're also going head to head now with the regulators. I mean, nobody's going to care when you manage $5 million because, hey, you're not making money, and as long as nobody complains, you're probably fine. As in, you're probably breaking the law, but nobody's going to get you yet. But once you have some semi-level of success, regulators will look at you and say, well, these guys are bypassing the intent of the law. And now you got to be ready for the fights in court. And I don't know if you want to spend all your time on that, but it's not really what I call a fun evening.
You know, it's a funny thing because for sure. I'm whatever there is a rule in the spirit of the law, I'm going to go above and beyond what they require, right? At the same time, I kind of see an environment where it kind of seems like they're letting people get away with everything. And you know, I'm a Republican, so I don't want to get too political about it, but I am a Republican. But as a Republican, I can admit that, like, it kind of looks like that for the next 4 years they might let people get away with even more. And you know, it's kind of hard not to look at some of the people doing these things and be like, maybe we should. But
well, I'd say as a European visiting Florida soon who doesn't want to get shot, I'm gonna refrain from political opinions. But anyway, yeah, sure, we probably see a more open regulatory landscape going forward for a couple of years, but it's not that new. I mean, we'll see a bit more of that. But you also have the Silicon Valley way of doing things, which has been, if you break the law in large enough scale, and you make enough money in a short enough time period, you have enough economic firepower to tie up governments, in plural, in court cases for as long as you need to fix the law breaking stuff you started out doing. I mean, you know, the Uber way. Let's start a taxi company without a taxi license and have employees that we don't call employees and we don't pay proper fees and so on. Which, you know, at least here in Europe, I'm not too familiar with the legal situation around those things in the US, but over here in Europe, they just broke every law available in massive scale, but they had enough money to fight the governments in court for a few years, and during those few years, they went back and fixed the things that made them money in the first place. So, I mean, if you have that amount of money behind you, you can break a lot of laws and get away with it, because you can afford to burn quite a few million in court cases. If not, I would say don't go up against the government. You can only do that if you have enough. If you have hundreds of millions behind you, you can go fight the government. Otherwise, I'd suggest to try to do what the government wants you to do, or at least don't annoy them unnecessarily.
Yeah. Well, I think we're coming up on time here. But, you know, I like it because we're going to have to do it again because there are some things about, you know, hints about what sort of things work and don't work and stuff that I like to get into. But I like, you know, kind of the more important thing is like, where are you actually going, right? That it makes a big difference into where you start digging. So I really appreciate it. And
great to be on, and anytime. Yeah, I'd love to come back and have a chat. Always fun to chat with you. Yeah,
well, I got a lot of backtesting projects in the back, and then I might come back in a couple months and ask a couple of questions. So
yeah, and I remember you told me, I can't remember which one. You told me which backtesting software you use. So I can suggest there's a book available if you want to go the Python way, which I can very much recommend.
Well, that's part of my indicators. I really want to make my own platform. Is the truth?
Then Python is your friend. If you want to make your own platform,
Yeah.
Python.
So it's more complicated than that, but I do it in C#, and I think that it should be in Python. So I would like to see a platform that kind of that was geared towards futures traders, but made the Python more available to them. Because the whole thing with Quantopia going under and all of that, this kind of left that space in a little messy.
I mean, Quantopian going under was actually in the end a good thing for Zipline, for the backtester that they built.
Yeah.
Because it was developing very slowly on the Quantopian. I mean,
and it's been much faster.
Wrong. Quantopian founders, those guys in management back then, they were good friends of mine. I spoke at their conferences in New York and Singapore a few times. I disagreed on the business strategy, but they did pretty good tech stuff. After Quantopian went bankrupt or merged into Robinhood, depending on your point of view, the software went out into the open source community.
Yep.
And it developed much faster. It became much better after. The biggest guy I have to thank for that is Stefan Janssen, German guy living in Chicago, I think. He's responsible for building, in my view, the best or at least most popular fork of Zipline, Zipline Reloaded. So
right.
Zipline became more stable and better after.
Yeah, it is. It's so the whole thing about how it integrates with your trading platform and all of these other things. Like there are actually a lot of problems to solve there, and like I'm one of those guys that like I can solve those problems. I just don't. You need to give me more time. Like so. Anyways.
Yep. Yeah. Let me know. I'll send you a book. If you want to go into it, I get you a copy of Trading Evolved. It's somewhere behind me.
Oh yes. Well, so I ran the futures trading. So I bought Following the Trend. I haven't bought Trading Evolved, but I did go and find the code and started running the code. So I ran the Momentum Futures strategy on there. So.
Mm-hmm.
And I only paid for the Norgate data for like 3 months to do it with, but that's where it gets iffy. It's like I can do backtesting in NinjaTrader. I get data through NinjaTrader and through Rhythmic. Okay, but how do I do it in Zipline? There's not really a way to do it. You could do it, but there's not really a way to do it. Okay, can I do the backtesting that I want in NinjaTrader? Well, kind of. Like you can hack it to do it, but it's not intended to like manage a portfolio. I can run the strategy against all instruments, but it's not necessarily a portfolio.
I think about 10 years ago, I switched from C#. I was pretty deep in C# for a while now. I think, like my French, I forgot most of it after a long time away from the natives.
Yeah.
I do everything in Python these days since quite a few years.
Yeah. So then on top of that, there's this the stuff that I'm working on because I'm short-term based. It has a lot more to do with market depth and ordering, whether a market order is a market buyer or market seller and that sort of a thing. And that's information that like you can see it live, but like to backtest with it, it's too expensive. Like they generally don't provide the data. So I've been making all these things for you to just collect it and save it yourself. So there's kind of like those three different pillars of the problem where I'm like, okay, but what if you just made a platform that was maybe it was written in Rust or something super performant for the trading side of it, but all of the custom programming parts were possible. It had Python bindings for them, and then you could do it all in one place, and it wouldn't be, because as an example, TradingView super popular, right? A lot of people write stuff in PineScript just because TradingView is so popular. It's accessible, right? So what you got to do is you got to get a platform like that has the Python side into it, right? So that now all of a sudden you can pipe in the rest of the Python ecosystem.
Sure. I mean, now you're thinking in business terms, right? I
Okay.
mean,
Well, I'm not. I'm thinking in technical terms. I don't know how to market it and all of those.
yeah, but you build a platform like that, and now you're no longer aiming to be the lead singing guitarist rock star.
Mm.
Now you're providing a service to the guys who wants to be the rock star. Now you're selling pickaxes and shovels in the gold rush, which is
That's exactly what it is. Yeah.
The better and safer money is. That's what I mean by thinking in terms of business. You know, it's not religion. I mean, it's not. You don't have to be married to a strategy or to a way of doing things. We're all running businesses in one way or another.
Mm-hmm.
It's just a different way of approaching finance and trading in general. I mean, if you think you can build a great platform and possibly make a business out of that, go for it.
Yep. Well, yeah, that's what we're doing. That's what we're doing right now. So.
Yep.
But yeah, that's it. And yeah. But thank you for coming and talking. We'll have to do it again.
Thank you. Yeah, definitely. Let me know. I'll be happy to be back.